I think from a monetary policy perspective, RBI decided to stay put on all fronts because as they wanted to see, first of all, the impact of a 125 basis of rate cuts.
So then in this entire scenario, where should investors look at and what's the way forward? Hello investors, welcome to Moneynomics by Axis Mutual Fund. I'm Shalini Gautam and I have with me our head of fixed income, Devang Shah. Today, me and Devang will discuss the latest developments which could be guiding the fixed income markets, which is the budget, the monetary policy and the trade deal. So Devang, let's begin with both the union budget and the policy. How do you think these work for the fixed income markets?
Yeah, thanks, Shalini, and welcome all. So first of all, as you rightly highlighted, I think this week was very heavy. Specifically, we had the entire budget as the monetary policy in the same week. From a budget perspective, specifically covering the bond markets, I think markets were looking at two or three aspects, which was how is government continuing with the fiscal consolidation path. And they have continued to deliver on that. So last year's fiscal deficit was met at 4.4, and the year forward, they are giving a fiscal deficit guidance at 4.3%. Secondly, the glide path to centre's debt to GDP is also continued to be followed, which will be currently 55.6, and next year onwards they will continue to show a glide path, move towards 50% by FY31. The more important perspective which markets were looking at was the gross and net borrowing. And I think slight disappointment was there on the gross borrowing numbers. The gross borrowing numbers were expected around 16.5 lakh crores. As against that, markets got slightly higher. They are now at around 17.2 lakh crore, which caused a little bit of disappointment. But I think when I look across at the budget and the credibility of the budget, how they've been conservative on the nominal GDP, tax revenues, I think we don't see any significant chances of any kind of slippages, and we believe that the budget is very, very credible. So from a bond market perspective, a bit of disappointment because of the high borrowing number. Coming to the policy, I think first of all, we need to acknowledge the fact that there was not much of expectations from markets into this policy, except for some liquidity measures, because RBI has been delivering a lot of liquidity measures intra-policy also. We spoke about that, right? Like in the last outlook also, RBI has been very, I would say, proactive in liquidity infusion, and they have done a lot of open market operations and FX buy sell to ensure that durable liquidity significantly improves. So market had gone with a, I would say, generally a consensus view on status quo on rates, and probably some infusion of liquidity measures might continue. I think from a monetary policy perspective, RBI decided to stay put on all fronts because as they wanted to see, first of all, the impact of a 125 basis of rate cuts. How do they pan out on growth and everything? And growth, high frequency growth continues to remain good. Secondly, there has been a sub revisions on uptick in inflation because of slight uptick in commodity prices. You've seen precious metals to be higher, base metals have started showing increase in prices. That is why I think probably there has been some provisions of CPI. So market, I think RBI thought that let's look at, we have delivered 125 basis rate cut, let's look at the way forward. On liquidity, because they announced a lot of measures in around December end and January, I think they decided that future measures will be dependent on how the FX intervention is there, how the core liquidity moves, and how the banking liquidity moves. And that is why they remain status quo in the monetary policy. But I think the most important perspective is they are still sounding very, very dovish. They believe at this point of time that rates are going to remain lower for longer, which has been our communication now or stance for almost 6-9 months, that rates are going to remain lower for longer. So we continue to believe the fact that this monetary policy, obviously it was a no event, but we are at the fag end of the rate cycle and rates are going to remain low for longer.
The US-India trade deal, what are your views and how does it impact the fixed income market?
I think first of all, it's a very, very positive deal. So from all perspectives, we are now back in the radar as compared to all the Asian peers, all our relative peers. We are at the 18% rate. I'm sure if you look at the fine print, it's quite a positive from the growth cycle. But we all understand what is positive for growth is not very good for bonds. So from a bond market perspective, I think the uncertainty which you'll be talking about, that if the trade deal continues to remain or tariff rate continues at 50%, there can be weakness on growth. Now the weakness on growth might not be there. Secondly, more importantly, the leakage on or the currency depreciation, or vulnerability on the rupee side, which was happening for some point of time, I think that might take some bit of respite. And INR, we've already seen INR appreciating a bit, and INR, RBI might not have to intervene too much on FX market incrementally. which again can be bad for bond markets, because if you're not going to intervene too much on FX and growth is positive, you neither need OMOs and not do need any kind of frequent monetary easing. That is why I think post the trade day, our bond markets did show some bit of softness on yields. But after the RBI monetary policy, most of the rally which happened reversed, and in fact now we are higher than where we were at the budget levels. So our perspective is incrementally from bond market perspective, the deal is overall very, very positive for macro, which is positive growth, positive currency. But from bond market perspective, it might lead to yields trending a bit higher.
So then in this entire scenario, where should investors look at and what's the way forward?
So I think we have outlined already in our year-end outlook, which we released in December, stating that this is a year where you will not see total actions from RBI. Already in the first monetary policy, only RBI didn't do anything. And we believe that there's not much left from monetary easing perspective for RBI to do. RBI done a lot on liquidity. We actually also wrote a note where we explained that how the 18 lakh crores of liquidity RBI has created and where that 18 lakh crores of liquidity has gone. So our perspective is very, very clear. RBI has been very proactive. RBI has done a lot of rate cuts. Incrementally from here on, there's not much joy on fixed income markets from a capital gain perspective. But investors need to shift their gears and needs to hold to the other aspects of fixed income, which is the lower end of the duration curve, and secondly, build up accrual as the theme. We have been talking about this now for more than 3 to 4 months, that investors needs to move to the short end of the curve. We continue to advise clients to stay invested in the short end of the curve for the year, and secondly, build in accrual through portfolio allocation. So these are the two strategies which we advise clients at this point of time on the basis of the macro environment.
Okay, thank you so much, Devang, for your views. And thank you to all our investors for joining in. Stay tuned.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.